Hello, my name is Wade Pfau. I'm a professor of retirement income at the American College. And as far as I know, that's a unique job title in the United States because, well, retirement income planning is a new field, and it's my distinct pleasure and to be here today. And I'd like to thank Patrick and the entire team at Paradigm Life for the invitation to speak about my favorite topic, this new area of retirement income planning. With retirement income planning being a new field, there's different approaches in the financial services industry about how to best approach retirement. And this presentation is about essentially comparing the two major approaches and looking at how an integrated strategy that considers both can prepare better retirement outcomes for clients who are planning for retirement. So the risk pooling side, that's from the insurance side, that's going to be able to use something like an income annuity to be able to pool risks amongst a large group of people to allow everyone in that group to be able to behave more like they're going to experience an average outcome. And then the risk premium is about using volatile investments like a stock portfolio to try to earn outsized returns and to try to sustain retirement in that way. So within financial services, there are some people who think that insurance is the only solution for all the problems. There are others who think that investments is the only solution for all the problems. But as retirement income planning matures and evolves, it'll be firms like Paradigm Life that really lead the way because they're willing to look at how do you actually integrate both to develop more comprehensive, complete strategies, efficient strategies for retirement income planning. And in that context, I'm going to be looking at a comparison between risk pooling and the risk premium in terms of meeting retirement spending goals, the lifestyle in retirement. Risk pooling will be looking at using annuities to meet retirement expenses and then using investments for other goals like legacy and supporting unexpected expenses or contingencies. And the risk premium strategy, though, would be just only investments, using investments to meet retirement expenses as well as any other legacy or contingency goals as well. And I want to look at how do you build more efficient, effective strategies and whether the idea that an investments-only strategy really is a wise way to approach the retirement problem. So with retirement income planning being a new field, I usually start to explain in presentations about why it's different from traditional wealth management or traditional investment management or wealth accumulation. And there are 7 basic reasons for this. The first, the reduced earnings capacity. That's the idea that once someone quits working, their lifestyle may become more vulnerable to a market downturn because they lose that lever of response to either work a little longer or save a little more. That, to the extent that it's difficult to return to the labor force, that reduces their potential to manage the risk in this way. I mean, what's really different about retirement is retirees have less risk capacity. And what that means is just their lifestyle becomes more vulnerable to market volatility. They could have a reduced standard of living if the markets go down. Reduced earnings capacity is one reason for that. Next is the visible spending constraint. So pre-retirement, people are always saving for something, but post-retirement, they're no longer adding new savings. They're taking distributions from their savings. And that's a constraint that changes the problem in retirement. It means that if the market is going down and the portfolio is losing value, to meet a spending goal, you have to take a bigger percentage of what's left to meet a particular number, the goal that someone's trying to achieve. And that visible spending constraint does change things, primarily because it leads to reason number 3, which is heightened investment risk. This is that the impact of investment volatility becomes more severe when taking distributions from savings. Again, if the market loses value, then you have to take a bigger percentage of what's left to meet the spending goal. And then that requires getting a higher return in the future just to keep that portfolio level. So that even if the overall market recovers, a portfolio may not recover because it's been pushed into a position of having a higher spending obligation, the spending percentage is increasing. This is known as sequence of returns risk. It's the idea that getting poor market returns early in retirement can have negative permanent impacts on that retirement plan. Getting good returns late in retirement, it can be too late for that to really help. Getting good returns early in retirement could lead to wonderful outcomes because it reduces the constraints on spending as a percent of the assets. But poor returns early in retirement can lead to a lower standard of living throughout retirement. The next issue is unknown longevity, and I'll be talking more about this shortly. It's really the overarching risk of retirement. It's the idea that people don't know how long they need to plan for their retirement, and if they're worried about outliving their money, and this idea is going to be important throughout the presentation. Anyone who's worried about outliving their assets really has to plan for outcomes that have a lower chance of happening, but nonetheless represent a risk. So that would be poor market returns and a long life. If you're planning that you don't want to outlive your assets, you plan for a longer lifetime and you plan for poor market returns. That means spending less, and that's really the constraint on an investments-only type of strategy. So this unknown longevity becomes an important part of that. Spending shocks are also important. These are the unexpected expenses that aren't really part of the main budget for retirement. Unknown healthcare shocks, long-term care shocks, fraud, divorce, having to help other family members, anything that can happen that really derails the budget and requires assets from outside whatever's been earmarked to cover spending needs. These need to be truly liquid assets that are available. Compounding inflation is an issue. Even a low, stable inflation rate can add up over a long retirement. Historically in the U.S., inflation has averaged 3%. Well, at 3% inflation, it takes 23 years for the purchasing power of $1 to drop in half. Or in other words, something that costs $1 today will cost $2 in 23 years with a 3% inflation rate. And so that means it's very potentially risky to have to put money under the mattress or to invest primarily in CDs or other types of assets that are not providing a return that can keep pace with inflation. There has to be a consideration of this. And finally, declining cognitive abilities, especially as people get into their 80s or 90s. It becomes increasingly difficult to manage investments and to do financial calculations and rebalance investment portfolios and so forth. And this really calls for having a trusted planning team in place. Especially related to this risk is if one household member is primarily responsible for the finances, and if unfortunately that person passes away first, the remaining members of that household may be really at risk if they don't have some plan in place to help take care of the finances. That can be a point where, in addition to grieving, to have all the stress about rearranging the finances, and then the potential for fraud and theft, as there are predators who may realize that there's not much financial sophistication there. It's really important to have a plan in place. And so retirement is different from just traditional investment management for these reasons. So often when I speak about retirement at an event, I like to use this old business school analogy that was brought up to date for retirement by Dirk Cotton at the Retirement Cafe blog. And so he's looking at this generally a breakfast you'd have at a conference. So what the old business school saying is the chicken was involved in making this breakfast and the pig was committed to making this breakfast. So the idea for retirement is when you're planning for retirement and you're still years away, you're still accumulating assets, you're more like a chicken. You're involved in your financial plans, but you can always make changes and you can always retire a little later, whatever the case may be. But once you've made that transition into retirement, you become committed to your financial plan. There's really no turning back. You have that less risk capacity for the reasons I talked about on that previous slide where, your lifestyle becomes more vulnerable to market volatility. And so how Dirk Cotton ended the saying, he says, retirees need to think like pigs. They're really committed to their financial plans. They really have to make sure that things go right. And they don't have that flexibility to necessarily be exposed to a lot to at least have their basic lifestyle exposed to market volatility. So I've been talking about retirement risks, but I just want to go into a little bit more depth about that to really set the foundation for how we're going to compare the risk premium and risk pooling, because that comparison is about how to meet spending goals in a way that most effectively can manage retirement risks. So this is a different way of expressing those risks. And here, longevity risk is on top. Again, that's the unknown planning horizon. If, unfortunately, retirement doesn't last very long, well, it's also not going to be so expensive, and there won't be time for other risks to become a problem. But it's those long retirements where it's great someone has a long, happy retirement, but that's also more expensive to fund there's more opportunities for other risks to develop. And so longevity risk becomes this overarching risk of retirement. And then the other major risk categories include market or macroeconomic related risks, investment volatility, changing interest rates, changes in tax laws or other public policy changes like around Social Security or other things, and then the sequence of returns risks, that not just the average investment return, but the order of those returns that really amplifies investment volatility. Then there's inflation, and inflation is a macroeconomic risk. I do just list it separately because even a low, stable inflation rate, not necessarily implying a macroeconomic problem, can still impact a retirement, because as prices slowly rise and the cost of living rises, the asset base may not be keeping pace, and it may be hard to sustain that lifestyle in the face of rising costs in retirement. And then personal spending shocks. These are things like healthcare expenses, long-term care expenses, helping other family members, the risk of divorce, fraud and theft, and so forth. Things that can really just derail the budget and derail the financial plan, that requires some sort of assets set aside from outside the main sources of retirement spending to make sure that there's something available to cover these sorts of spending shocks or contingencies. So longevity risk. And the numbers in this slide may be surprising, because often when we hear about life expectancy and longevity, it's going to be based on numbers like all participants in the Social Security program or the average U.S. population. What's important to recognize is that people who are listening to this presentation are going to tend to be above average. I mean, some people, unfortunately, will not necessarily live long retirements because of disease or other unexpected types of surprises. But the listeners of this really are from Lake Wobegon. That's Garrison Keillor's idea, where everyone's above average. That people who are planning for their retirements will tend to be more highly educated, have higher incomes, and as such will live longer than the average American. We shouldn't look at their longevity for people watching this presentation based on the average American. So the numbers I use for this are from the Society of Actuaries, and they're based on the longevity of people who buy annuities, which is a subset of the population that really can expect to live longer than average. I mean, part of the reason people buy annuities is they plan to live, they at least don't have a terminal illness or something that would cause the average life expectancy to be reduced. This is based on the numbers that I think are most effective and realistic to consider for the types of people that would be watching this presentation. And what we have here is not life expectancy from birth, but from age 65, specifically for a female. Females do tend to live longer than males, and the next slide will show that in more detail. But if you're talking about a couple, you're looking at how long will the longest living member of that couple survive. Well, that's an even bigger age, because it requires both people passing away. So it's going to be a number that's bigger than either the longevity for a male or female by themselves. But this is for females at age 65, and what you're seeing here is a 10% chance that this female will not make it to age 75.8 or almost age 76, or a 90% chance she'll live beyond that. And then the median, this is 50% of the time someone will not live to age 90 and a half, but maybe surprisingly, 50% of the age 65, like female, higher income, higher educated type females today will live beyond age 90 and a half. And then as we keep going, the 90th percentile is age 100.1, or basically age 100. 90% of age 65 females today will not make it to age 100, but 10% of today's 65-year-old females who are of this subpopulation that are planning for their retirements will make it beyond age 100. 10% chance of living beyond age 100. And that's longevity risk. It's not knowing where someone's going to fall. So what age do you plan to? Do you plan to live to age 90? Well, that's going to be risky, because if your plan only works until age 90 and you live to age 91 or 92 or any age beyond that, the plan's going to fail. So that leads someone to say, well, where am I comfortable? Maybe somebody's comfortable planning to age 100. There's still a 10% chance that they live longer than that, but it's a trade-off, because the higher the planning age, the less you can spend to really spread those assets out over a longer period of time. And that will become more clear in later slides as well. So how do you strike the balance of that trade-off? That is longevity risk. And here's just another way of expressing that longevity risk by showing survival probabilities to different ages, where this is showing if somebody has a planning age of 95, longevity risk is the risk of living beyond age 95. For males, it's a little over 20%. For females, it's about 30%. For the longest living member of a couple, it's about 45%. That at least one member of the couple will live beyond age 95. So a 30-year planning horizon from age 65 to 95, that used to be considered a conservative number. It's not so conservative anymore because people are living longer and longer. This is a different data source, and these are showing longer life expectancies. But the point of this is it's showing how longevity has at least improved over time. So this is for the aggregate U.S. population. In 1950, males from age 65 could expect another 12.8 years, females another 15 years. By 2010, and again, these are for the whole U.S. population, so these numbers are less than what I've been showing in the previous slides, but males 17.7 years, females 20.3 years. In both cases, about 5 more years of life. For the males, it was 4.9 years. For the females, it was 5.3 years. Longevity is improving. People are living longer and longer, and that trend is expected to continue. And that's why today's 65-year-olds really can expect to live longer than their parents, longer than past generations. Longevity is continuing to improve, especially for the more highly educated, higher income type Americans who do save for their retirements and plan for their retirements and work with financial advisors. Then we have market risk. And this is a way to show market risk, looking back using U.S. historical data since 1926 and considering a 30-year retirement, because that's where a lot of the discussion about retirement planning assumes a 30-year retirement. It was this idea that a 65-year-old couple could conservatively plan for 30 years. Now, I was just talking about how, because longevity is improving, that's not so conservative anymore. It's almost life expectancy for the longest living member of a couple. But at least when people started talking about these things in the 1990s, it was a little bit more conservative at that time. And it's kind of the benchmark. We have the 4% rule, which is the idea that with a portfolio of 50 to 75% stocks, you can take out 4% of the assets at retirement. In later years, then that gives you a spending level that in later years you can increase for inflation and have that money last 30 years. That's kind of the benchmark approach from an investments-only world. And this is taking the same historical data used to create the 4% rule and just looking at the average outcome. So on average, over 30 years, you could have withdrawn, if you got the average return over this historical period, a 6.5% withdrawal rate would have worked. Your wealth is 100 at retirement, and 30 years later, your portfolio would hit 0. That's that cyan-colored line. It's just this gradual decline in wealth, spending 6.5% plus inflation over a 30-year period. And the bluish-purplish lines, those are the actual paths of wealth for different 30-year retirements from history. So, for instance, from 1926 through 1955, from 1927 through 1956, and so on, all the way up through from 1986 to 2015. So for all those different 30-year periods, outcomes varied a lot from the average. That's market risk. Market risk is being on the unlucky side of that. In the worst case, wealth would have been depleted after about 13 years. There's a few other cases where the wealth would have been depleted by 15 years. There's a lot more cases where wealth was depleted by 20 years, and so on. About half of the cases, because we're looking at the average, so half of the time you're below average, half the time you're above average, about half of the time, wealth is depleted before 30 years. The other half of the time, there's still wealth left after 30 years. Excuse me. And there's a few very lucky cases where wealth can even grow. A hypothetical retiree in 1982 could have used about a 10% withdrawal rate, we know in hindsight. And so with a 6.5% withdrawal rate, their wealth doubles, and then it goes off the chart. You can see one of those cases going above the 250 more than 150% growth in real wealth, that's just an amazing outcome with amazingly good market returns. But that's the retirement risk, that not everyone's going to get those types of high market returns. There are going to be retirements that don't have that sort of success, and that's the market risk in reality. It's being on the unlucky side of that distribution. And then what do you plan for? Again, it's like, well, if there's a 10% chance that your money runs out by age 20 in this case, or by 20 years into retirement, or whatever the case may be, you start trying to be more conservative. And then the solution here is lower the spending rate. Spend less, and that will help all these lines to shift upwards. And keep spending less and less until you find a point where you're comfortable. But again, that requires spending less. And that's essentially the risk of trying to manage that type of risk on one's own. And I like to say there's the 4 L's. The financial goals of retirement are the 4 L's. These are lifestyle, meeting the overall lifestyle throughout retirement. Longevity, making sure that at least the essentials can be covered for as long as one lives. Liquidity, this is having assets that are truly liquid and that are not earmarked for other spending goals, that are available for contingencies. And so this point is important because liquidity, I think, gets misunderstood a lot. Suppose someone believes in the 4% rule that says they can safely spend 4% of their assets. Suppose they want to spend $40,000 and they have $1 million portfolio. Well, the 4% rule is saying, according to the 4% rule, they can spend that $40,000 safely. They have $1 million in an investment portfolio. But does that household have any liquidity? In a technical sense, they do. They have $1 million, but in an important sense, they do not. That entire $1 million has to be earmarked to meet the spending goal, to meet that $40,000 spending goal. It means those assets can't be used for something else. If there's a need to help a family member or something outside of the budget, you can't really use that $1 million for anything else because all $1 million has to be set aside to cover the $40,000 spending goal. There's not true liquidity. True liquidity is having assets available after earmarking what's needed to meet different spending goals. And that's going to be an important point about the risk pooling, is that if you can meet the spending goal more cheaply or earmark less assets to meet the spending goal through an income annuity, you can potentially have greater, real, true liquidity for other contingencies in retirement. And then legacy is just simply the desire to leave a legacy to family or to the community, to the next generation. And this is my retirement income optimization plan. It's the way I think about building a retirement plan. We have the goals on the left. Those are the 4 L's that I was just describing, the longevity, lifestyle, legacy, liquidity. And then on the right, we have the liabilities of retirement. These are obligations, the expenses. These include the essential expenses. So these are the basics, like basic health expenses, but housing, shelter costs, clothing, basic food, and so forth. What you need to really at least have a minimal lifestyle in retirement. And then discretionary expenses are things that are more discretionary. So travel, nice restaurants, maybe a country club membership, that sort of thing, that it's not the end of the world if those expenses can't be met, but they really are part of the overall standard of living. So that's lifestyle, in addition to the longevity for the basics or essentials. Legacy, and then contingencies, the spending shocks, the healthcare, long-term care, those types of unexpected expenses that can happen. Then retirement income planning is about how do you most effectively match assets to liabilities. How do you put all the household assets and organize them in a way that they can best meet those liabilities in retirement? And these assets can be divided between reliable income sources, things like Social Security benefits, any defined benefit pensions. These are the traditional income for life type pensions, not the 401k or IRA, but pensions that provide a guaranteed monthly income for life. And income annuities or other types of annuities, and then bond ladders, which is for retirement, means holding an individual bond to its maturity date and then spending the value of that bond at maturity. Then on top of that, you have the diversified portfolio, which that's the traditional investment portfolio. That's the stocks and bonds and alternatives or whatever assets are used, but that's the diversified investment portfolio to cover more discretionary expenses and legacy. And you can see a yellow curve that says probability based on this chart. That's looking at these two different schools of thought about retirement. Probability based is more of the investments only side. The probability-based school is comfortable using a diversified portfolio to also meet the essentials, but the alternative, the risk pooling or the partial annuitization or the integrated strategy, really is not comfortable having stock market volatility for the essentials. That you first want to try to cover the essentials through more reliable, contractually guaranteed type income sources, and then use a diversified portfolio on top of that for discretionary and legacy. So that's the safety first or the more integrated type risk pooling strategy would not have that yellow curve. That's only for the investments only side. And then other reserve assets to cover contingencies. That could be a stockpile of cash outside of the investment portfolio. That could be different types of insurance, long-term care insurance, health insurance. It could also mean the cash value of a permanent life insurance policy. That's a popular contingency fund, or even a fund to help cover discretionary expenses if in a market downturn. But that's cash value of permanent life insurance tends to grow without the possibility of decline, uncorrelated with what's happening in the stock market, so it can provide that extra reserve asset. Home equity is another, really has to be considered as part of the retirement income plan. Is someone going to downsize, or where are they going to live in retirement? And with their home equity, how can they use that as part of an overall strategy or as a reserve asset and so forth? And then family support, the community support, the safety net in place. That's another type of reserve asset that can help manage the expense related to contingencies. Okay, so now that's really an overview of retirement income planning. And now we're going to get into the details of comparing risk premium and risk pooling. But to get to that, we also need bonds. We need the risk-free type of asset, quote-unquote risk-free. It doesn't protect against longevity risk, but holding individual bonds to maturity protects against market risk, assuming the bonds don't default, which we'll set that aside for now, but it helps to protect against market risk. And so we'll start there. We'll see how much can somebody spend with bonds, and then we'll look at how that can be enhanced through risk pooling and or through the risk premium by holding stocks. So fixed income or bonds is a starting point here. Here's the 10-year Treasury rates going back to 1871. And if you've been paying attention to the news, you know interest rates have been at historic lows. Over the summer, they got to about 1.5%. They are up higher now, over 2% again, but still at the low side of history. The early 1940s was the only other time we have this experience with 10-year Treasury yields hovering around 2%, and very little experience of below 2%. So this is nominal interest rates, and for most of the rest of the presentation, I'll be talking about real interest rates. The distinction is real interest rates have the impact of inflation removed from the interest rate. So they're going to be lower numbers because inflation, to the extent inflation is positive, that there is inflation, the real interest rate after inflation will be less than the nominal interest rate. I like talking about the real interest rates because they're going to be connected to spending that can grow with inflation. If I could say you can spend $40,000 a year with a nominal interest rate, that would imply you're not going to increase your spending for inflation. But with the real interest rate, stripping out the impact of inflation, that's really meaning $40,000 a year that will then grow for inflation throughout retirement. So that's the point of using real interest rates instead of nominal interest rates. And that's the distinction from this slide and this estimated real interest rates for 10-year maturities. So today we have TIPS, Treasury Inflation Protected Securities. They provide real returns. They're issued by the government. They've been around since 1997. So we know what real interest rates are since 1997. The TIPS provide you a real interest rate plus whatever inflation happens to be. So if inflation is low, you get a lower return with TIPS. If inflation is high, you get a higher return with tips. Now, I said they've been available since 1997. Prior to 1997, we don't know what real interest rates were. So the Cleveland Federal Reserve Bank estimated, the reason these are estimated is because real interest rates are the interest rates, nominal interest rates, the treasury rates today, or at the different times, but less what people believed inflation was going to be in the future. And that's where we don't have the very good data. We don't know what people thought inflation was going to be in the future from different points in history. So the Cleveland Federal Reserve has tried to estimate those since the early 1980s, and this is what they've come up with. And again, we see this decline in real interest rates. In a standard economics textbook, it usually talks about a 2% real interest rate. But we've been below 2% for a long time. In 2013, we even had this extended period of negative real interest rates. Now, it's much easier for real interest rates to be negative because it just means you're getting that interest rate plus inflation. So if inflation is high enough, you still get a positive interest rate. But the real interest rate before inflation can be negative. It means the purchasing power will not keep pace with inflation, is not projected to keep pace with inflation. Now they are positive again, and they're a little bit higher today than they were in July, but this next slide is showing the last time I updated it, July of this year, for the TIPS yield curve. Again, it is a little bit higher today, but this is what TIPS were yielding in July of this year. And it's an upward sloping yield curve, which is pretty common. Longer-term bonds are more volatile in response to interest rate changes than short-term bonds, and so they usually offer a higher yield to provide compensation for that additional risk. So you can see up until about 10-year maturities, till about 2025, real yields were negative. But again, it's the return you get from TIPS is that real yield plus inflation. So if inflation is high enough, you will get a positive return. But in real terms, in nominal terms, maybe positive, but in real terms, it's going to be negative. And then you can see after about 2040, the maturities, those TIPS get to the levels of a little bit more than 0.5% real. So there are some years in the 2000s when new 30-year TIPS were not issued. So we have some years where there's no maturing TIPS, and I just connected those dashed lines in between years when there were no maturing TIPS. Then what I'm going to do on the next slide is construct a 30-year TIPS ladder, a 30-year bond ladder. Let me go to it now. There are a lot of numbers here, but what this is showing is how much does it cost to build a ladder of receiving $10,000 per year plus inflation for the next 30 years using the available TIPS. And in those years where there's no TIPS maturing, I just buy extra of the earlier maturity and set that aside to be used in those later years. Okay, so all these numbers, adding them up, what we have is the cost of building 30 years worth of a $10,000 income stream, adjusting for inflation, $281,708. That implies an inflation-adjusted withdrawal rate of 3.55%. That's the 10,000 divided by the almost 282,000. That's how much you withdraw as a percent of the retirement date assets. And then you get to adjust that 10,000 by inflation in subsequent years. And then looking at those cash flows, a premium today of $281,708, then providing $10,000 of real income, inflation-adjusted income for the next 30 years, implies that you're getting an investment return out of that of 0.4% real. Now today, the interest rates are a little higher, so in all the later examples, I'm going to use a 0.5% real, which is a little bit more reflective of where we are today. So I'm just going to assume the bonds are going to give you a 0.5% real return no matter the maturity, which is just a simplification that basically links to what we're seeing in this sort of slide, is that when you build a 30-year TIPS ladder, you're getting an average of all those different yields. Some were negative, some were more than, in this case, more than the 0.41%. But when they're put all together, you're at about 0.4%, or today, since July, about 0.5%. Now, this is a chart showing you the relationship between your planning horizon, and your investment return, assuming a fixed investment return. So this is assuming you build a bond ladder and then different real interest rates. How much can you spend in real terms? And if this were nominal interest rates, it'd just be how much could you spend without inflation adjustments. But if we treat these as real interest rates, this is how much you can spend with inflation adjustments for a 65-year-old with $1 million. So as I was saying, I'm just to simplify a little bit there, I'm saying suppose bond yield, the real TIPS yields are at 0.5%. Then we can focus on that column. How much can you spend getting a 0.5% real return? Well, it depends how long you're planning to live for. If you're only planning to live to age 70, you're looking at $200,000 a year. If you're planning to live to age 85, $52,404. If you're planning to live to age 95, $35,800. And that's pretty close to the TIPS ladder payout rate, which was like 3.55%, or $35,500. Very close to just this simplification of just a flat 0.5% real return. If you're planning to live to age 100, $31,060. To age 105, $27,508. So, and this is where, again, the more worried somebody is about outliving their assets, the less they have to spend to be able to sustain that over a longer period of time. And this is basically what they can do with bonds today. Now we'll think about annuities. And there are many different kinds of annuities, but I'm trying to do a simple analysis to explain the basic concepts. So I'm going to think in terms of a life-only, single premium immediate annuity, basically exchanging a lump sum value today for a guaranteed income stream for life. And I'll be calculating these with real interest rates, so these will be real inflation-adjusted income annuities. So you get some initial spending level plus the inflation adjustments in subsequent years. And I'm just going to simulate how much would one of these cost based on my assumptions about interest rates and mortality to be able to compare to the bond ladder approach, and then later to be able to compare to the investment portfolio approach. So this is how an income annuity is priced, and this is a little bit more math, but the idea is somewhat straightforward, and I'll just try to hit the highlights here, that I'm assuming a 0.5% real interest rate. So if you're going to get $10,000 a year for as long as you live, first, you can discount the future payments for the fact that they would earn interest. So you can see in the column discounted value of income, at age 75, the cost of $10,000 of real income today is $9,513. Basically, if you put $9,513 in a bank and it grew it, or in a TIPS, and it grew at a 0.5% real return for the next 10 years, it would grow to be the $10,000 that you need. So since those future dollar amounts are able to grow from today, you need less today to be able to supply them. And if you're building a bond ladder, that would be the relevant column. The discounted value of income would be the relevant column. But the income annuity has risk pooling. Those who don't live as long subsidize those who live longer. And so from the insurance company's perspective, that means we can consider the impact of survival probabilities, which are the probabilities someone will survive to actually to receive that income. That leads us to the last column of this chart, the survival weighted discounted value. That is those discounted values of income, but also multiplied by the probability of actually surviving to receive those incomes. That makes the income annuity cost less than the bond ladder, because you only receive the income if you survive. We saw a 30-year bond ladder was over $280,000 on the earlier slide. But here, this is just showing for the 40 years at least. This is for life, of course, but at least to age 104, you're looking at an annuity cost of $231,559. And that's an annuity payout rate of 4.32%. That's higher than the bond ladder can support. That's because of the risk pooling, the fact that you only receive the income if you're still alive. And that's what lets those who live longer receive the subsidies from those who don't live as long. These are just a hypothetical annuity based on a 0.5% real interest rate and that Society of Actuaries mortality data that's relevant for the types of people who are watching this presentation. So an income annuity, the payments from the annuity are return of the principal, the initial lump sum premium, any interest received on that principal, and then the mortality credits. That's the risk pooling, and that's the fact that you get to multiply the payments by the probability of surviving to receive them. That's a unique source of returns not available to an investment portfolio. And that's going to be really important because it's going to make risk pooling very attractive. Now we have to recognize we are in a low interest rate world. That's going to impact every strategy. There's going to be less interest available no matter what someone does. But you still receive the principal, you're still going to receive a smaller amount of interest, and then also the mortality credits. And then here's comparing the income received from an income annuity versus a bond ladder. So for the bond ladder, we're talking about, for both, we're talking about a 65-year-old female. This is going to be our example. For the bond ladder, she wants to plan to live to age 100. She's comfortable with the idea that there's still a 10% chance that she'll live beyond age 100, but she doesn't want to increase that planning age any further because it just requires her to spend less and less. So she's planning to live through age 100 with a 0.5% real interest rate available to her for her investments. Here's what she could spend. It's the $31,060. That was the number on the previous table. Most of that is the return of principal, and you can also see the interest portion that does decrease over time as the principal decreases. Then at age 100, the principal's gone. The bond ladder has depleted all of the asset. There's no more asset beyond age 100. So the income annuity is invested in a bond portfolio. It does have that return in principal and that interest, but the income annuity pays $43,118. That additional payment before age 100, that's mortality credits. That's because, as we'll see later, the income annuity pays based on living to about age 89 and a half or so. Because that's basically the median, a little bit less than the median. Those who then pass away before that age subsidize those who live longer, and the extra interest earned, that age can be a little bit less than the median. So the $43,118, and then if she lives beyond age 100, the bond ladder has depleted all the assets, but the income annuity continues beyond that age, for as long as that person lives. Now, an important point to make, I hear all the time that it's a bad time to buy an annuity because interest rates are low. But actually, low interest rates make annuities relatively more attractive for somebody who's already retired. Because if somebody's already retired and is spending from their assets, well, if interest rates go up in the future, great, they'll get a higher payout rate from their annuity, but they're going to be spending from their assets in the meantime, and then their bonds may experience capital losses as interest rates rise. They're not necessarily going to be better off. And what this slide is showing is, at different interest rates, what's the cost of building a bond ladder, for the same example, for a 65-year-old female through age 100, and then what's the cost of buying the income annuity. So when interest rates are low, both the bond ladder and the income annuity cost more. When interest rates are high, they both cost less. But what's important is the difference between them. When interest rates are low, the bond ladder costs 41% more than the annuity at a 0.5% real interest rate, basically where we are today. Well, if interest rates were 3.5% real, then the bond ladder would only cost 28% more than the income annuity. So the fact that interest rates are low does make everything more expensive, but the bond ladder is even more expensive relative to the annuity because the mortality credits are still the same, but the interest portion for both the bond ladder and the annuity are less. The annuity lets you rely more on the mortality credits, so it doesn't have as big of increase in cost as the bond ladder, and that's a very important distinction. Okay, so that's the annuity. Now the investment portfolio. Now we're going to add the risk premium. We're going to look at a diversified portfolio of stocks and bonds. These are the components of market returns. We have on the bottom inflation, and then we have real bond returns. Bonds tend to earn more than inflation, at least hopefully. And we have short-term government bills, long-term government bonds, which tend to have higher yields than short-term because of the increased risk with the longer maturity. Excuse me. And then long-term corporate bonds. And those tend to have a higher return than long-term government bonds because of the extra default risk for the company. And then, because of the greater volatility for stocks, they tend to provide higher returns than bonds. And that's the risk premium, the equity risk premium. It's the additional returns for stocks above bonds, at least, not in any particular year necessarily, but at least over the long term. And there's an expectation stocks provide more than bonds. Small cap stocks provide even more than large cap stocks, large capitalization stocks, because they're even more volatile. And here's the historical numbers for all of this, going back to 1926. So that 0.5% real interest rate that I'm talking about, that's essentially a weighted kind of long-term government bond. Historically, excuse me, long-term government bonds had an average return of 6%. That's a nominal return. You can see that inflation was 3%. So the real return on long-term government bonds was 3%. Excuse me, 3% plus 3%. Now that's that 3% real return. That's where today we're not at 3%, we're at 0.5%. But we can see historically, large capitalization stocks like the S&P 500 had an average return of 12%, which is 6% more than long-term government bonds. The historical equity premium for large cap stocks was 6%. On average, large cap stocks earn 6% more than long-term government bonds. Now, there are a lot of reasons to think that in the future the equity premium could be less, but I'm not going to mess with that assumption. To give the benefit of the doubt to stocks, I'm going to keep the historical equity premium of 6%. But I'm not going to add that to that 6% historical average. First, I'm talking about real returns, not nominal. So that'd be large cap stocks 9%, long-term government bonds 3%. But I'm going to add that to that 0.5% interest rate that we're at now, because that's the relevant number for today. So that's a real return for large cap stocks of 6.5% with the same historical volatility, which is about 20%. Now, spending from investments, you get to spend the principal, you get to spend interest and dividends, interest from bonds, dividends from stocks, and then the risk premium is capital gains, the growth in the price of stocks, so you can sell them for more than you bought them. That's the capital gain. There could be a capital loss, but hopefully over the long term, there's capital gains, the additional risk premium provided by stocks. And that's the sources of returns from this investment portfolio. Excuse me. So the sources of income from investments in low interest rates. Well, dividend yields are low as well, but we have low interest, low dividends. That category is less. You could think of dividends as being along with interest there. Then we have the return of principal and then capital gains, and that's the risk premium. So that's going to have to play a more important role in a world where interest and dividends are less. Now back to the retirement spending issue. So the implication of the fact that people are living longer and interest rates being low is that we somehow have to think about moving towards the lower left-hand corner of this. That means spending less. If we're doing this with bonds, we're back to this column, where, as I'm saying, basically we can think of bonds as providing 0.5% real return. Then the amount we're willing to spend depends on our planning age. For this example that I'm talking about, the planning age is 100. That's allowing for spending of $31,060. Okay, but if you're willing to plan for less, you could spend more. If you're even more worried about outliving your assets, you would spend less than that. Now, risk pooling with the income annuity lets you spend $43,118. And that's, as you can see, that's slightly more than the spending level at age 90. It's like the spending level is somewhere between age 89 and 90. Risk pooling lets you spend like you're only going to live to age about 89 and a half. That's important to consider because for somebody who's worried about outliving their assets, they're going to want to plan for a higher age than their life expectancy. They're going to want to plan to age, sometimes you hear 90, but that's their life expectancy, 95, 100, or beyond. That implies spending less than the income annuity. And then here's a chart comparing the spending, the liquidity, and the legacy for the bonds versus the income annuity. I don't really have the time to go through this chart in detail. What I'm talking about today, it's an article that will be in the Journal of Financial Planning in February. I'd be happy to share an advanced copy of that through Paradigm Life and Patrick if interested. Otherwise, that article is freely available on the internet once it's published in February, where you'll have a chance to really digest this diagram. But I do want to make sure there's time to talk about risk pooling. I'm sorry, not risk pooling, but risk premium as well. And this is a situation. So if you're not using the income annuity, you're thinking about the risk premium with investments. What that means is you're going to assume a higher return than the 0.5% real that bonds can provide. Now, how high are you willing to assume? That's really the question. But the idea is you're going to spend more today under the assumption that you'll get a higher investment return to justify spending more today. And that's going to create risk because if you do get the higher return, it's fine. You're going to be able to sustain a higher spending rate throughout the retirement. But if you don't get that higher return, you're going to run out of money before the planning age that you have picked. And that's the risk involved with the risk premium. But that's the idea. Assume a higher return. But this is where risk pooling really doesn't get the full consideration due to it, because actually, if you're worried about outliving your money, this whole idea of assuming a higher rate of return doesn't actually work out. So the way a lot of investment managers build financial plans for their clients is to create a financial plan using financial planning software that does what's known as Monte Carlo simulations. It's simulating future market returns and calculating the probability that the plan will work. I don't think there's any advisor that would use a 50% chance for success and be comfortable that if your plan has a 50% chance for success, then you're in good shape. I don't know of any planner or advisor that does that. I think the standard benchmark would be a 90% chance for success. That if your plan has a 90% chance for success, you should be in good shape. Maybe you have to make some small adjustments, but for the most part, that should be fine. Well, 90% chance for success implicitly means a lower investment return. And what this next slide is showing is not what the financial planning software shows. The financial planning software shows a probability of success. This is reverse engineering a fixed investment return that supports that probability of success. And so this is where, if you want a 90% chance for success, you would be using the 10th percentile investment return. Let me just narrow in on a few of these numbers. The 10th percentile investment return, if you're planning to age 90, is 0. If you're planning to age 95, it's 0.3% real. If you're planning to age 100, it's 0.5% real. Now this is overturning the whole idea of the risk premium because bonds were providing a 0.5% real. The reason the return is higher for higher planning ages is because you spend less with higher planning ages. And that reduces that sequence of returns investment risk, that it's less likely your portfolio gets caught in a downward spiral if you're using a lower spending rate from the beginning. That lets you use a higher investment return. But the point is these investment returns are not really exceeding bonds. So this slide's showing you the implied investment returns. This slide's showing you the spending levels connected to those returns. And that's what my point. So at age 90, you can spend more than, if you're planning to age 90, you can spend more than if you're planning to age 100. But we can compare this to the income annuity. The income annuity supported the $43,118. All the red numbers are less than the income annuity. All the bluish, purplish numbers are more than the income annuity. This is basically where you're at. So the red numbers are all cases where people want to be more conservative. And when they want to be more conservative, they're forced into a position of spending less than the income annuity can support. So for example, if somebody wants a 90% chance that their money will still they'll still have something left at age 100, then we look at that 10th percentile column to age 100. That implies spending only $30,945. That person would be better off with an income annuity. If someone is much more risk-seeking, say they only want to plan to age 90, and they're willing to accept a 25% chance that their money will run out, or just a 75% chance that their plan will work through age 90, there's a good chance that plan's not going to work, but that would allow them to spend $46,775 without guarantee. That would be more than the income annuity, but that's being connected to a rather high chance of failure as well. That's the issue. You could potentially spend more, and it might work, but there's going to be a notable probability that it's not going to work as well. And that's the comparison, in a nutshell, between risk pooling and the risk premium. So let me just kind of get to the highlights here, because these last few slides, again, will be discussed in more detail in the article that will be in the Journal of Financial Planning. But we can really get to the highlights to summarize the key points in our last couple minutes together. So what this all brings together is risk pooling provides a guarantee support for the income for life. There's contractual guarantees providing protection from longevity and market risk. For a conservative retiree who's worried about outliving their money, it allows less assets to be earmarked to meet the spending goal, because the income annuity payout rate is based on earning bond returns through life expectancy, through about age 90. Whereas somebody who's worried about outliving their assets may have to assume something less, like assume living to age 100 and assume a lower market return than bonds could provide, or potentially, depending on what probability they're willing to accept that the plan won't work. So for a conservative retiree, risk pooling will allow less assets to be earmarked to meet the spending goal. And mortality credits really provide a unique source of returns that tend to get belittled by the investments industry, but they really are competitive with the risk premium. The idea that stocks outperforming bonds, well, mortality credits provide a similar type of return that is competitive with that. It provides a guarantee for lifetime spending, and if somebody lives beyond their life expectancy, it's going to generally help support greater legacy, and then also greater true liquidity throughout retirement. And so the risk pooling strategy is using risk pooling for spending goals, the longevity and lifestyle goals, the essential and discretionary expenses, and then using investments for legacy and contingency. Partial annuitization is really about integrating risk pooling with the risk premium. And someone who takes the investments only approach, well, that really its only advantage is it can potentially allow for a greater legacy in the short run. If retirement is short, there might be a bigger legacy. And it's a lower probability, but if somebody does have the upside growth, they could potentially support greater spending and legacy throughout their retirement. Now, they may not really get to spend more because they're worried about outliving their money. They might really just leave a much bigger legacy than planned. It requires self-management for longevity and market risk, and it requires more conservative spending that still doesn't have any particular guarantee behind it. So I think really integrating risk pooling and risk premium is going to create more efficient strategies for retirees. It's not only investments, it's not only insurance, and it's going to be those retirees who are willing to draw from both insurance and investments who are going to have the most satisfied and enjoyable retirements and the best retirement outcomes. And that's really what retirement income planning is all about. So thank you for listening, and it's been my pleasure. You can find me on Twitter or email me if you have any further questions. I'm also happy to send you the article that this presentation was based on. Again, thank you very much and have a good day.